You see it in the headlines all the time, right? These massive corporate mergers, big numbers, even bigger promises. But behind all that jargon and the crazy high valuations, there's actually a simple, really powerful logic that decides if a deal is going to create a new giant or just a giant mess. Today, we're going to unpack that logic.
Okay, so just to give you a sense of the scale here, take a look at this chart. Mergers and acquisitions, M&A for short, it is a colossal industry. We're not talking big money, we're talking peaks of over $4 trillion a year. That's like the entire economies of some countries changing hands.
So with so much money flying around, how can anyone, a CEO, an investor, heck, even us just reading the news, tell if a billion-dollar deal is a stroke of genius or a total disaster waiting to happen? Is there any way to cut through all that noise?
Well, the good news is it turns out there is. Underneath all the super complex financial models and the boardroom drama, there's a surprisingly simple way to figure out if an acquisition actually makes any sense, and it all just comes down to some basic math. It really all starts with this one core idea. For the company doing the buying, the acquirer, the value they create is simply what they get minus what they pay. I know, it sounds almost too obvious, but this right here, this is the foundation of every single successful deal.
So let's break that down just a little bit more. What you get isn't just one number. It's the company's value as it is, plus any improvements the new owner can bring to the table. And what you pay is the company's market price, plus any extra sweetener. That's the acquisition premium you have to throw in to close the deal.
And this visual makes the math totally clear. See that bar on the left? That's what you're getting. The company's $1 billion value, plus the $400 million in improvements you think you can make. Now look to the right. That's what you paid. The $1 billion market price plus a $300 million premium. The gap between them, that $100 million, that's the new value you just created.
And this is where it gets really simple. Since a company's standalone value and its market value are usually about the same, we can cancel them out. It all boils down to one golden rule. The value you create is just the value of your improvements minus the premium you paid. That's it. That is the whole game.
Okay, so our golden rule really has two levers you can pull. Let's dig into each one. First, you've got those improvements. You'll hear people call them synergies. And second, you've got the price tag, the premium you actually have to pay.
Now, synergies can sound like some kind of corporate buzzword, but it's not. It's about real, concrete cost savings. We're talking about things like combining your purchasing power to get better deals on supplies, getting rid of extra warehouses to make your distribution more efficient, or merging all the back office stuff like HR and accounting.
And the data shows you exactly where the biggest bang for your buck usually is. A third of the savings can come from just stopping redundant research projects. Another quarter comes from slashing overhead costs. These are the places where 1 + 1 can actually equal less than 2, in a good way.
Now let's talk about the other side of that golden rule, the premium. This chart shows you what a delicate balancing act this is. I mean, look at the grid. If you pay a 30% premium, you have to find 30% in improvements just to break even. To actually make money on the deal, you got to do even better. The more you pay, the more pressure you're under to deliver huge results.
Okay, let's zoom out a bit. We've seen the math for one deal. But what separates the companies that win at this game over and over from the ones that maybe get lucky once or worse, make one giant bet that just blows up in their face?
And the research here is really fascinating. Take a look at that top bar. Companies that take a programmatic approach, basically making a steady stream of smaller, smarter deals, they consistently get the best returns. They do way better than companies that almost never make deals, and especially better than those who try to swing for the fences with one single massive deal. Turns out, in M&A, practice really does make perfect.
Let's see our golden rule play out in the real world. In that RF Micro deal, they paid a pretty small 10% premium, but were gunning for massive 60 to 70% improvements. That created a ton of value. Now look down at Clorox. They paid a whopping 60% premium. Just to make that work, they had to pull off incredible improvements. We're talking 70 to over 100%, which left them with a much, much smaller margin for success.
Okay, so we've got our golden rule. It makes sense. But there's this other metric you hear about all the time when a deal is announced. It's something executives and analysts absolutely love, but it might just be a dangerous distraction.
It's called EPS accretion, and all it means is that after the deal is done, the new combined company's earnings per share are higher than the buyers were before. Now on the surface, that sounds like a total no-brainer, right? More earnings for every single share, that has to be a good thing.
And on paper, oh man, the math looks so good. In this example, whether they pay with cash or stock, the earnings per share go up. The deal is accretive. This is usually the very first thing a CEO will point to when they're trying to sell investors on a deal.
So, the logic seems simple. Your EPS goes up, that means the deal is a success, and investors should be popping the champagne. It's the cleanest signal you could ask for, or is it? Well, here comes the punchline. This chart shows how the market actually reacted a full year after these deals were announced, and you gotta see this. The deals that were accretive, where EPS went up, got a positive reaction 52% of the time. Okay, but the deals that were dilutive, where EPS actually went down, got a positive reaction 54% of the time. There is basically no connection.
I mean, the analysis says it all. The market, it seems, is smart enough to look right past this little accounting trick. It knows that real value isn't about a short-term bump in your EPS. It's about long-term cash flow and the real math of our golden rule.
And really, that's the big takeaway here. The companies that are best at this aren't just empire builders chasing headlines. They're disciplined. They are obsessed with creating real value. They focus on that simple math, making sure the improvements they bring are bigger than the premium they pay.
So the next time you see one of those blockbuster merger announcements, you can look right past the noise. You can ignore all the talk about EPS and just ask the two questions that really matter. What are the real improvements here? And how big was the premium they paid? Because now you know the math that actually counts.
And that's the simple math of a multi-trillion-dollar deal. Thanks for joining us for this explainer.